The purpose of trading. Trading fulfills several important roles in society and the economy. First is liquidity. Traders ensure that assets can be easily bought and sold. Without active traders, prices would stagnate and markets would freeze. Second, price discovery. Through millions of trades, markets determine the true price of an asset based on what people are willing to pay. Third, risk transfer. Trading allows businesses and investors to manage risk. A farmer can sell his future harvest in advance, a future contract, to protect against falling prices. Fourth, capital formation. Companies raise money by selling shares to investors who then trade those shares on the open market. Fifth, wealth distribution. Trading helps distribute capital across the economy, rewarding innovation, efficiency, and risk taking. In a sense, trading is the bloodstream of modern capitalism, keeping money moving, funding innovation, and connecting people across borders. Types of trading. Trading comes in many forms, each with its own goals, time frames, and risk levels. Here are the main categories. First, stock trading. This is the buying and selling of shares in publicly listed companies. Stock traders speculate on price movements or invest for the long-term growth. Stock reflect ownership in businesses. When you buy a share, you literally own a small piece of that company. Second, Forex trading. Forex, foreign exchange trading, involves exchanges one currency for another, like US dollar for euro. It's the largest market in the world with trillions of dollars traded daily. Forex traders focus on global events, interest rates, and macroeconomic trends. Third, commodity trading. Commodities include raw materials like gold, oil, silver, coffee, and wheat. Traders buy and sell these goods to profit from price changes or to hedge against inflation and currency shift. Fourth, cryptocurrency trading, a modern form of trading that deals with the digital currencies like Bitcoin, Ethereum, and others. It's decentralized, highly volatile, and attracts both short term speculators and long term believers in blockchain technology. Fifth, derivatives trading. Derivatives are financial contracts that derive their value from other assets. Examples include futures, options, and swaps. Traders use them to speculate on price direction or to protect against risk. Sixth, bond and fixed income trading. Here, traders buy and sell debt instruments like government or corporate bonds. The goal is to profit from interest rate changes or to earn stable returns. Each type of trading appeals to different kinds of people, from cautious investors to high risk speculators, but all rely on the same principle: buy low, sell high, or vice versa. How markets work? Markets are ecosystems of buyers and sellers. Every second, thousands of people around the world make decisions to buy, to sell, or to wait. These actions create a constant push and pull that determines prices. The concept of supply and demand. At the heart of every market lies one simple law. When demand exceeds supply, prices rise. When supply exceeds demand, prices fall. If millions of people want to buy Apple stock because they believe in the company's future, the price goes up. If they lose confidence, the prices drop. Trading is in many ways a reflection of collective human belief. The role of exchanges. An exchange is the marketplace where trading happens. Examples include the New York Stock Exchange, NASDAQ, London Stock Exchange, or Binance for crypto. Exchanges act as intermediaries. They ensure trades are executed fairly, prices are transparent, and buyers are matched with sellers in real time. Market participants. Markets are made up of different types of participants. First is retail traders, individuals trading their own money. Institutional traders, banks, hedge funds, and investment firms with large capital. Third, market makers, firms that provide liquidity by always being ready to buy or sell an asset. Speculators, those who try to profit from short term price changes. Hedgers, companies or investors who use trading to protect against future losses. Together, they create the dynamic environment we call the market: fast, unpredictable, but full of opportunity. Trading strategies and styles. Trading is not one size fits all. Each trader develops a style that matches their goal, personality, and time commitment. Day trading involves buying and selling assets within the same day, sometimes in minutes or hours. The goal is to capture small, rapid price movements. Day trading requires focus, quick decision making, and strong emotional control. Swing trading. This strategy holds trades for several days or weeks to capture medium term trends. It combines technical analysis with the fundamental insights. Swing traders balance patience with agility. Position trading. Position traders hold assets for months or even years, aiming to benefit from long term trends. This approach requires deep analysis and a belief in the asset's future value. Scalping, a high speed strategy that takes advantage of teeny price changes, often placing dozens or hundreds of trades a day. Scalping is about precision, discipline, and speed. Algorithmic and automated trading. In modern market, many trades are executed by computers and algorithms. These systems follow pre-programmed rules and react to data faster than humans. Algorithmic trading now accounts for a large percentage of all trades worldwide. Each of these methods shows that trading is not random. It's systematic. Behind every successful trade lies a plan, a reason, and a goal. The importance of risk and reward. Every trader must learn the balance between risk and reward. The market offers opportunity but also uncertainty. Even the best traders lose sometimes. What separates winners from losers is how they manage risk. Position sizing. Never risk too much on a single trade. Stop loss order. Predetermined exit point that limit loss. Diversification. Spreading investment across different assets to reduce risk. Emotional discipline, avoiding revenge trading or impulsive decision after losses. In trading, capital preservation is the first rule. Making money comes second. A trader's longevity depends more on managing losses than chasing profit. The tools of a trader. Modern traders have access to powerful tools that make analysis and execution faster and more efficient. First, trading platforms. Software like MetaTrader, TradingView, or Think or Swim. Second, chart and indicators, visual representation of price movements, moving averages, RSI, MACD, etc. Third, news feeds, real-time updates from Bloomberg, Reuters, or market APIs. Fourth, economic calendars, tracking events like interest rate decisions, GDP data, and earning reports. Fifth, risk management tools, position calculators, stop orders, and portfolio trackers. But even with all the technology in the world, the most powerful tool remains the human mind. The ability to interpret information, control emotion, and act with confidence. The human element. Trading is both a science and an art. While it relies on data, maths, and charts, it's ultimately driven by human behavior, fear, greed, hope, and uncertainty. Markets are emotional ecosystems. They rise on optimism and fall on panic. Understanding human psychology is just as important as mastering technical analysis. A trader who can control their emotions has a far greater edge than one who simply memorizes patterns. The evolution of trading. Trading has come a long way. Ancient markets, physical trade routes like the Silk Road, stock exchanges 1600s to 1900s, the Dutch East India Company created the first shares, modern exchange followed. Electronic trading 1970s 2000, computers replaced paper and telephones. Digital revolution 2010 to present, online platforms and mobile apps made trading accessible to everyone. Future trends, AI, blockchain, and decentralized finance are redefining what's possible. Today, anyone with a smartphone and internet connection can access the same market once reserved for Wall Street professionals. Trading has become democratized, giving power back to individuals. Why the fundamentals matter? Before learning advanced strategies or chasing big profits, every trader must master the basics, the fundamentals, understanding market risk, psychology, and tools from the foundation of all success. A trader who knows how and why market move can adapt to any condition. The fundamentals are timeless, they remain the same whether you are trading rice in Asian, Japan, or Bitcoin in the digital age.